Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, October 21st. The week starts with a bang with major global indices rallying on various reasons, including hopes of easing tensions on the trade and geopolitical front and ample support from the fiscal and monetary funds, and denying all that could eventually go wrong. Gold, on the other hand, rallies too in tandem despite a solid risk-on sentiment across the global financial markets, but the gold volatility index is now at levels that actually start ringing the alarm bell among some investors. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So the week kicked off well on both sides of the Atlantic Ocean and beyond as investors collectively dropped the fears over the heating trade war between the US and China, bad credit worries, US shutdown story, French credit downgrade from the S&P Global, a major outage at Amazon Web Services, which happens to be the world's biggest cloud provider that actually froze many online services for hours globally yesterday, renewed fight in Gaza over the weekend, and the not so great meeting between the Ukrainian President Zelensky and Donald Trump. Instead, the focus was put on the possibility of yet another round of easing tensions between the US and China as, and I found this extremely hilarious, Donald Trump told Fox News that his threat of 100% tariffs on Chinese exports toward the US was not sustainable anyway. So the S&P 500 jumped more than 1% yesterday over the session and almost 2% within the last two trading sessions since Friday, led by a rally in technology stocks there. Then Amazon, that actually caused massive disruptions across the globe, rallied 1.60% yesterday on confirmation about how big and how important AWS was for businesses around the world. Then, Apple printed its first all-time high level this year on reports that said that its iPhone 17 sales were 14% higher than the previous model sales during the same period after their release, without, however, changing the very fact that Apple is nowhere to be found in the AI race that actually powers other technology stock valuations. Now, here in Europe, the ambience was quite well as well. The defense stocks here had a great rebound yesterday following last Friday's dip on fragile peace in the Middle East following the weekend news of tensions in Gaza and another fruitless meeting between Trump and Zelensky, a meeting where actually the US Secretary, Mr. Pete Hegseth, wore a tie that eerily resembled the Russian flag, as media reports highlighted to say how bad that meeting might have gone, with ASML also adding 2.66% in Europe yesterday. The Stoxx 600 index approached a fresh all-time high level too. Listen, even the CAC 40 in France traded near an all-time high level yesterday, and that despite the rising borrowing costs in France that followed a rating downgrade from the S&P last Friday. And in the UK, the FTSE 100 index gained 0.52% yesterday, led higher by defense and miners. Energy stocks see little appetite these days as crude oil keeps falling on strong peace hopes, with the US crude now consolidating below the $60 per barrel psychological level. But Fredilo, for example, which is a gold miner trading in UK that's having the time of his life, actually added 56 points to the FTSE 100 index yesterday and is up by more than 350% this year, which is way more than gold and Bitcoin. And as per gold, well, demand remains quite tight near an all-time high level, and that despite a risk-on day yesterday that actually led Mohammed El-Erian subtly highlighting that the underlying fundamentals that actually drive gold prices have simply changed. Indeed, since the beginning of this year, So since Donald Trump is back to the White House, gold rallies on risk on days, it rallies on risk off days, it also rallies when the US yields are up, it also rallies when the US yields are down. No matter what, gold rallies. And remember, many investors now believe that the $5,000 per ounce target for gold will likely be achieved and easily broken to the upside. This being said, if we dig deeper into technicals, there's something unusual going on in the gold market today. And it's that the volatility in this market is rising while the price is rising as well. And this is unusual because normally you expect the volatility in the market to remain low in bullish market conditions and rise when investors sell in a panic mode in bearish market conditions. So this anomaly might mean that the risks to the gold rally today are building, and that despite the supportive global rhetoric for gold and the waning appetite for traditional currencies, including the US dollar, and that could mean that a correction in gold prices could lead to a sharp sell-off in the coming weeks. How sharp and how fast, I can't tell you. But back in March 2022, the gold's volatility index was at similar levels and gold fell 20% in 4 months that followed. But anyway, there is no guarantee that history will repeat itself. It's just still very interesting to look at and just be aware. Anyway, coming back to the global indices and the global market rally, Asia had a second strong session with Korean Kospi jumping to a fresh all-time high level this morning, and Chinese stock markets also recovering past days losses. Then the Australian ASX index also tested an all-time high level this morning at the time I'm talking here on news that the US and Australia actually signed a deal to boost the US access to Australian rare earth metals, lifting the mining stocks there. Meanwhile, the rare earth metals and the critical metals are set to rebound further, according to many people out there, after Friday's dip, with companies active in the sector will likely gain more on the Western's push to increase their independence from China when it comes to rare earth metals that are used for many digital applications across the globe. And finally, in Japan, Nikkei hit a fresh record high today as well after Takaichi won a key vote to become Japan's next PM. So she will be pushing for supportive monetary policy for the Bank of Japan and also ample government spending to boost growth in Japan if, of course, investors allow her to do so. Because note that the long maturity Japanese yields, so the borrowing costs there, are at multi-decade high levels, which makes me think that she and Mr. Abe, to whom she is compared to, do not have the same margin to act. But hey, investors are happy until they are not, and riding the bull market so far has been much fruitful than sitting on the sidelines and watching the rally develop further. So the conclusion is the risk rally is on. In the FX markets, the US dollar is better a bit this morning, but the greenback remains under the pressure of trade uncertainties between the US and the rest of the world, the US shutdown story, and the dovish shift in Fed expectations. But the dollar-yen rallies strongly on, Takaichi news, as her appointment as the next PM means, as I said, that she will be pushing for a softer Bank of Japan stance as much as she could. So that would mean that the dollar-yen is poised for further gains in the coming weeks on further convergence between the Fed and the Bank of Japan policy outlooks. The euro dollar, on the other hand, is having quite a hard time to benefit further from the weak dollar appetite across the globe, as the widening gap, the widening spread between the French and German yields, and that due to the French political chaos and the recent rating downgrade of France, limits appetite in the single currency. Then across the channel, cable also remains under pressure, but the news that British pension funds and insurers will finally consider regional investment opportunities in exchange of better conditions, probably, that will be offered to them by the British government, that could include tax breaks and regulatory easing, for example. I don't know, could eventually help Rachel Reeves improve appetite for UK assets and sterling, but I wouldn't bet my shirt on it just yet. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
This content is intended for individuals who are familiar with financial markets and instruments and is for information purposes only. The presented idea, including market commentary, market data, and observations, is not a work product of any research department of Swissquote or its affiliates. This material is intended to highlight market action and does not constitute investment, legal, or tax advice. If you are a retail investor or lack experience in trading complex financial products, it is advisable to seek professional advice from a licensed advisor before making any financial decisions. This content is not intended to manipulate the market or encourage any specific financial behavior. Swissquote makes no representation or warranty as to the quality, completeness, accuracy, comprehensiveness, or non-infringement of such content. The views expressed are those of the consultant and are provided for educational purposes only. Any information provided relating to a product or market should not be construed as recommending an investment strategy or transaction. Past performance is not a guarantee of future results. Swissquote and its employees and representative shall in no event be held liable for any damages or losses arising directly or indirectly from decisions made on the basis of this content. The use of any third-party brands or trademarks is for information only and does not imply endorsement by Swissquote, or that the trademark owner has authorized Swissquote to promote its products or services. Swissquote is the marketing brand for the activities of Swissquote Bank Limited, regulated by FINMA, Swissquote Capital Markets Limited, regulated by SISEC, Swissquote Bank Europe SA, regulated by the CSSF, Swissquote Limited, regulated by the FCA, Swissquote Financial Services Limited, regulated by the Malta Financial Services Authority, Swissquote MEA Limited, regulated by the Dubai Financial Services Authority, Swissquote PTE Limited, regulated by the Monetary Authority of Singapore, Swissquote Asia Limited, licensed by the Hong Kong Securities and Futures Commission, and Swissquote South Africa Limited, supervised by the FSCA. Products and services of Swissquote are only intended for those permitted to receive them under local law. All investments carry a degree of risk. The risk of loss in trading or holding financial instruments can be substantial. The value of financial instruments, including but not limited to stocks, bonds, cryptocurrencies, and other assets, can fluctuate both upwards and downwards. There is a significant risk of financial loss when buying, selling, holding, staking, or investing in these instruments. Swissquote makes no recommendations regarding any specific investment, transaction, or the use of any particular investment strategy. CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. The vast majority of retail client accounts suffer capital losses when trading in CFDs. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Digital assets are unregulated in most countries and consumer protection rules may not apply. As highly volatile speculative investments, digital assets are not suitable for investors without a high risk tolerance. Make sure you understand each digital asset before you trade. Cryptocurrencies are not considered legal tender in some jurisdictions and are subject to regulatory uncertainties. The use of internet-based systems can involve high risks, including but not limited to fraud, cyber attacks, network and communication failures, as well as identity theft and phishing attacks related to crypto assets.